Hey everyone. I know a lot of you are probably wondering how the stock market might react to this upcoming election in 2024. So we're doing a deep dive into some historical data today, see what we can learn, see if there are any patterns.
Yeah, absolutely. And you might be surprised to find out that election years aren't always like, total market mayhem. That's what we hear a lot. But
And we actually have some interesting analysis that we're going to unpack today that might just change how you think about investing, especially during an election year. For instance, did you know that the market often goes up after an election? Like, no matter who wins.
it's true. It's a trend that's held for decades. But
Right.
before we get to that post-election bump, maybe we should talk about those jitters, those pre-election jitters we all know. Maybe dread a little bit.
Okay, so let's talk volatility. Looking back at the last four elections, 2008, 2012, 2016, and 2020, things were a little rocky leading up to Election Day.
Oh, absolutely. The S&P 500, for example, swung within a range of plus or minus 8% in the month leading up to those elections. So some decent ups and downs, investors trying to anticipate that outcome.
Wow, so like a 16% swing. That's pretty wide. Can you give us a sense of what happened in, let's say, 2020? I mean, that election felt especially dramatic.
It did. The week before the election, the market dipped 5.6%, only to roar back up 7.3% the week after.
Wow.
Yeah. And then, of course, there's 2008, you know, year many of us would like to forget, when the market rose 4.6% the week before the election and then plummeted almost 8% the week after. That was largely due to the unfolding financial crisis at the time, though.
Okay, so big swings are definitely possible, but is this level of volatility like unique to election years, or is the market just generally always kind of unpredictable?
Well, the market always has some level of fluctuation, right? That's kind of the nature of it. But election years tend to amplify those swings just due to the uncertainty. Remember, businesses and investors, I mean, we all like predictability, and elections kind of throw a wrench into that. But here's the interesting part. This short-term volatility doesn't always predict long-term trends.
So you're saying don't panic if the market takes a bit of a roller coaster ride, in the weeks leading up to election day.
Exactly. It's like watching a speedboat zigzagging across the lake.
Yeah.
It might seem chaotic, like from moment to moment, but it's still generally heading in one direction.
Okay, I like that analogy. So if we zoom out a little, look at the bigger picture, what happens after all the pre-election drama kind of settles down? Does the market recover or does it just stay unpredictable?
Well, our analysis shows a fascinating trend, actually. Since 1960, the S&P 500 has mostly gone up in the month following a presidential election.
Really, even if like the outcome wasn't what the market wanted, so to speak.
Yeah, it's pretty surprising. We're talking potentially significant gains. For example, the S&P 500 surged 10.9% after the 2020 election. And even in 2016, when many predicted a downturn, it still jumped 5.6%.
Wow, those are some pretty impressive numbers. So why does this happen? Why this post-election bump? Is it just a coincidence or is there like a deeper reason behind this trend?
Well, there's definitely more to it than just chance. I think the key driver is really the reduction of uncertainty. Once the election is decided, we kind of move from a state of what if to, okay, here's the plan. And that clarity, regardless of who wins, that clarity tends to boost confidence.
So it's less about which party wins and more about the fact that we finally know who's in charge and can start to anticipate those policies they'll put in place.
Precisely. It allows businesses to adjust their strategies, investors can make more informed decisions, and then the market as a whole can stabilize, kind of find its footing.
Okay, that makes sense. But what about this time around? 2024, what's the analysis saying? Will we see that post-election bump again, or is there something, different on the horizon this time?
Well, this is where things get interesting. Our projections, based on a combination of cycle analysis and historical patterns, actually point to a potential downturn leading into the 2024 election, followed by a rally afterward.
Hold on. You're saying we might see a dip before the election. Can you unpack that a bit? What is cycle analysis and what's pointing to this pre-election dip?
Sure. Cycle analysis is basically a way of looking at historical market data to try and identify recurring patterns or cycles. Think of it like the tides. We know there's a natural ebb and flow. By studying the historical data, we get a sense of when those tides might be high or low in the future.
So you're looking for those similar patterns in market data to try and anticipate future movements. What kind of patterns are you seeing that suggest a dip before the election?
We're seeing some indicators that the current upward trend in the market might be nearing its peak. Now, it's important to remember that cycle analysis is just one piece of the puzzle. External factors like the overall economy, global events, even just geopolitical tensions, can all influence the market.
Right. So we can't just rely on past patterns to predict the future. It's more about understanding like the potential influences and probabilities.
Absolutely. The market is a very complex system. It's influenced by a lot of variables. But by studying that historical data and understanding the potential cycles, we can gain some valuable insights into what might be ahead.
Okay, so we've got this potential pre-election dip on the radar. But hold on, if there's a chance the market might drop before the election, shouldn't investors just sell everything now and buy back in after things settle down, you know? I mean, who wants to ride that roller coaster down when you could just hop off and wait for it to go back up?
Well, that's a tempting thought.
Sure.
But market timing, trying to predict those exact peaks and valleys, it's incredibly difficult, even for seasoned professionals.
So trying to time the market perfectly is probably not a winning strategy.
It's very, very difficult. Instead of trying to time the market, focus on time in the market. That means building a solid strategy, one that aligns with your financial goals, your risk tolerance, your time horizon, and sticking with it even when things get, a little bumpy.
Okay, don't panic. Make rash decisions, focus on the long game. But how does that play out, like practically? What are some steps investors can take to build a more resilient portfolio, especially during an election year?
One of the most important things is diversification. Think of it like this.
Wait, before you go into diversification, let's just make sure we're all on the same page. What is diversification and why is it so important, when we're talking about elections and the stock market?
Okay, yeah. Diversification is basically the idea of not putting all your eggs in one basket. Instead of investing all your money in, say, one company or one sector, you spread it across different asset classes, industries, even different geographic regions.
Okay, so you're basically building a safety net for your investments. Why is that especially important during an election year?
Because elections can introduce this extra layer of uncertainty and potential volatility, right? If all your money is concentrated in one particular area of the market,
Yeah.
and that area happens to be negatively impacted by the election outcome or just, policies of the new administration, your portfolio could take a hit.
So diversification helps to mitigate that risk by spreading your bets. Like if one part of your portfolio takes a dip, hopefully another part is doing well enough to cushion the blow.
Exactly. It's about creating a more balanced, more resilient portfolio that can kind of weather those ups and downs, no matter which way the political winds are blowing.
Okay, that makes a lot of sense. So diversification is our foundation for navigating this election year uncertainty. What other strategies can help us, kind of weather the potential storm? I know earlier you mentioned this term stop loss order. Can you explain what that is and how it might be useful here?
Sure. A stop-loss order is basically an instruction that you give your broker to automatically sell a stock if it drops to a certain price. So it's essentially a safety net to limit your potential losses if the market takes an unexpected downturn.
So let's say I own some shares of a company and I think it might be vulnerable to, I don't know, new regulations that could be introduced by the new administration, right?
All right.
I could set a stop loss order to sell those shares if the price drops below a certain point, just in case.
Yeah, exactly. It's a way to kind of protect yourself from a potential downside scenario without having to constantly, monitor the market or make some sort of panic decision in the moment.
Okay, that sounds pretty handy. Is there a downside to using stop loss orders? I mean, couldn't the stock rebound quickly after it hits your stop loss price and then you'd miss out on the gains?
Yeah, that's a valid concern. There's always this trade-off between managing risk and missing out on potential gains. Stop-loss orders aren't a perfect solution, and you should use them strategically based on your risk tolerance and how you assess that specific situation.
So it's not just about setting random stop loss orders for every stock you own. It's more about like identifying specific investments that you think might be sensitive to election-related risks and then using those stop loss orders to try and mitigate those risks.
Exactly. It's about finding the right balance for for your individual investment strategy.
Okay, that makes sense. Now, I know you mentioned that certain sectors tend to be more sensitive to election outcomes and policy changes. The analysis we looked at highlighted technology, financials, and healthcare. Can you talk about those sectors and why they're so sensitive to the political landscape?
Sure. These sectors they're really heavily influenced by government regulations, policies, spending decisions. Changes in tax laws, for instance, can have a significant impact on financial companies. New healthcare regulations can affect pharmaceutical companies or insurance providers. And then the tech sector, I mean, we've seen this in recent years. It's at the forefront of debates about data privacy, antitrust laws, even content moderation.
So it's not just about who wins, but the specific policies they enact and how those policies might affect, those companies operating in these sectors.
Precisely. It's not always as simple as one party is, good for a certain sector and the other party is bad. It's about understanding the nuances of those proposed policies and how they might create opportunities or challenges for specific companies.
Okay, so it's about doing your homework, reading those policy papers, listening to the debates, really digging into the details to understand how those potential policy shifts might impact your investments.
Absolutely. But informed investors are empowered investors.
Okay, so we've covered a lot of ground here. We've talked about those historical patterns of market volatility during election years, the importance of diversification and using those stop-loss orders strategically, and of course the need to understand how policy changes can really impact specific sectors. I'm sure our listeners have a ton of other questions. So let's take a quick pause. We'll come back with more insights and strategies for navigating this 2024 election and the stock market. Stay tuned.
We were talking about the impact of elections on certain sectors before the break, like technology, financials, and healthcare. And, it might be tempting to try to predict which sectors are going to boom or bust based on, who wins. But it's not always that simple.
Right. It's not like some sort of switch gets flipped where one party wins and it, automatically benefits one sector while hurting another. It's way more nuanced than that, right?
Yeah. Yeah, absolutely. It's way more nuanced. Take healthcare, for example. It's a sector that's, constantly in the spotlight during elections. But, the reality is that both parties generally agree on, the need for affordable, accessible healthcare. I think the differences often lie in how they aim to achieve that goal.
Oh, wait.
One party might favor a more market-driven approach, while the other might lean towards a more government-led system. And the impact on specific companies within that healthcare sector, like insurance providers or pharmaceutical companies or hospital systems, it's going to vary depending on the specifics of those policies.
So it's not just about blindly investing in healthcare because you think, oh, this party's going to win, so it's going to benefit.
Yeah.
You really have to look at their policies and understand how those policies might impact the different players within the sector, right?
Exactly. It's about, informed decision-making, not making assumptions just based on party affiliation. And this applies to other sectors as well. Think about technology. One party might focus on, promoting innovation, deregulation. That could really benefit certain tech startups and disruptors. But at the same time, they might be more lenient on, antitrust issues, which could raise some concerns for those bigger, more established tech giants.
So there's always kind of a flip side, like a potential downside, even in a sector that's generally considered to be aligned with one particular party or another.
Exactly. It's a complex web of interconnected factors, and the impact of any given policy can really kind of ripple through the market in ways you might not even expect.
Okay. So we've established that trying to predict which sectors are going to win or lose based solely on who wins the election is probably not the best approach. But let's flip the script for a second. What if you're a new investor just starting to kind of dip your toes into the market? Is it a bad idea to start investing during an election year knowing there could be some turbulence ahead?
That's a great question, and it's one that I hear a lot, and my answer is usually this. The best time to start investing is when you're ready to start investing. Don't let the political cycle dictate your financial decisions.
Don't let that fear of the unknown or fear of an election hold you back from building that solid financial foundation.
Absolutely. Investing is a long-term game. And over the long term, the market has consistently trended upward despite all those short-term fluctuations, including those that are, driven by elections. But if you're new to investing, I think the most important thing is to start with a solid plan. Educate yourself on the basics of investing. And most importantly, start with an amount of money that you're comfortable potentially losing.
Yeah, that's crucial advice. Whether you're, seasoned investor or just getting started, only invest what you can afford to lose. Let's say you've already got a portfolio. You're comfortable with your risk tolerance. You're in it for the long haul. What are some key takeaways from our discussion today that they can apply to their investment strategy as we're, heading into this 2024 election?
I think one of the most important takeaways is this. Don't let the election derail your long-term investment goals. It's really easy to get caught up in all the hype, the predictions, the constant news cycle, and you might make impulsive decisions based on fear or excitement. But remember, successful investing is really about discipline, patience, and sticking to your plan.
So tune out the noise, focus on those fundamentals. But how do you actually do that? Like, in a practical sense, what can investors do to kind of stay grounded and avoid those emotional decisions during this time?
Well, one thing you can do is revisit your investment plan. Make sure it still aligns with your financial goals, your risk tolerance, your time horizon.
Hmm.
If you've experienced any major life changes recently, like a new job, a growing family, or just, your financial situation changed, you might need to adjust your plan accordingly.
So it's not like a set it and forget it thing. You need to actively review and update it as your life circumstances evolve, right?
Yeah, exactly. Another thing you could do is assess your portfolio's diversification. Are you adequately diversified across those different asset classes, industries, geographic regions? If not, now might be a good time to rebalance your portfolio and maybe reduce your exposure to areas that you think, could be vulnerable to election-related risks.
So if you're feeling anxious about this potential, pre-election dip, especially in those sectors we talked about, like technology, financials, healthcare, you might consider shifting some of those investments into more defensive positions.
That's certainly one option. Defensive investments like bonds or dividend-paying stocks, those tend to be, less volatile than growth stocks. They might provide a bit more stability during turbulent times. However, it's important to remember there's no one-size-fits-all approach. The right strategy for you is going to depend on your individual circumstances, your risk tolerance.
Right. Okay, so we've got diversification, rebalancing, potentially shifting to more defensive investments. Those are potential strategies for navigating this election year uncertainty. But what about those, what if scenarios? Let's say that pre-election dip we were talking about actually materializes. How can investors protect themselves from those big losses?
Well, one tool that we haven't talked about yet is the stop loss order.
Yeah.
And this is basically an order you place with your broker to automatically sell a stock if it falls below a certain price. It's like setting up this safety net to limit your potential losses.
So let's say I'm worried about a specific stock in my portfolio, maybe one in a sector that I think might be, negatively impacted by the election. I could set a stop loss order at, let's say, 10% below the current price. And if it drops by more than 10%, it'll automatically get sold. That'll limit my losses.
Exactly. It's a way to kind of manage risk and protect your downside. But it's really important to use stop loss orders strategically. If you set them too tight, you might get stopped out of a stock that rebounds really quickly, and then you miss out on potential gains. And if you set them too loose, they might not really provide, much protection at all.
So it's a balancing act. You need to find that sweet spot where you're mitigating the risk, but not giving up too much of that potential upside.
Exactly. And remember, stop loss orders they're just one tool, in your arsenal. They're not a foolproof solution. And they shouldn't be used in isolation. They should really be, part of this well thought out investment strategy that takes into account your individual, circumstances and risk tolerance.
Okay, that makes sense. So we've talked about a lot of potential strategies for navigating this upcoming election, the potential volatility that it could bring to the stock market. But I think it's worth reiterating one really key point. Knowledge is power. The more informed you are, the better equipped you'll be to make, those sound investment decisions, regardless of the political landscape.
You got it.
So read up on those candidates' platforms, pay attention to the debates, understand their proposed policies, and think critically about how those policies might impact your investments. And of course, stay tuned to, podcasts like this one to get those expert insights and analysis.
Exactly. Don't be afraid to ask questions, to do your own research, and even, seek out guidance from trusted financial professionals if you need to.
Now, I know some listeners might be wondering about some specific scenarios, like how should day traders approach election year investing? What about those long-term investors? Are there different strategies that they should be considering? Let's explore some of those specific scenarios and see, how different types of investors might approach this 2024 election and the stock market.
Stick with us. We're back and ready to jump into those specific investor scenarios we mentioned before the break, like those "what if I'm this kind of investor" questions.
Yeah.
Let's start with day traders. They approach things very differently from someone who's, investing for retirement, right?
Oh, yeah, for sure. Day traders, they actually thrive on volatility. They're looking for those quick price swings, often within a single trading day, so they can make a quick profit. And so for them, an election year, it can actually be it can be a time of real opportunity.
So they're not really like picking sides politically. They're just trying to ride those waves of uncertainty that elections can create. Exactly. They might be looking at things like, um, debates or polls,
Hmm.
even the election results themselves as potential catalysts for market movement to really focus on, technical analysis, chart patterns, momentum indicators, just trying to anticipate those short-term price swings, regardless of, the underlying political landscape.
It sounds like a pretty high-stakes game, fast-paced, not for the faint of heart.
Right.
But what about the rest of us who are playing the long game, the buy and hold investors, focused on building wealth over decades? How should they approach an election year?
Well, for those long-term investors, the key is to remember that elections are really just blips on the radar, in their overall investment journey.
Yeah.
The market has weathered so many, elections and political shifts throughout history, and it'll continue to do so. Their focus should really be on staying the course,
Hmm.
you know, sticking to that investment plan and not getting swayed by that short-term noise, even if it's election related.
So if you're investing for, I don't know, retirement, you shouldn't let the outcome of an election derail your long-term strategy.
Exactly. In fact, for a long-term investor, an election year dip could actually be a buying opportunity.
Hmm.
If you believe in the fundamentals of the companies that you're invested in, and you have a long time horizon, a dip in the market can be a chance to acquire more shares at a discount.
That's an interesting way to look at it. So instead of being scared of that volatility, you see it as a potential opportunity. But that requires a certain level of, I guess, confidence in your strategy, right?
It does, and it's not for everyone. If you're, easily spooked by those market fluctuations, or you're not comfortable with that idea of buying when everyone else is selling, maybe sticking to your plan and just riding out the storm might be a better approach for you.
It goes back to that knowing yourself, your risk tolerance, and those investment goals. That's why it's so important to have a well-defined plan in place before making any decisions, especially during those uncertain times like an election year.
I couldn't agree more. Having a plan, it really provides clarity and direction, and it helps you, avoid making those emotional decisions that you might regret later.
Okay. We've covered a lot of ground today, from, those historical patterns of election year market volatility
Yeah.
to the importance of diversification, those stop loss orders, that sector specific analysis. We've also talked about, how different types of investors, from day traders to those long-term buy and hold investors might approach this upcoming election. But before we wrap up, I want to leave our listeners with one final thought.
Okay.
It's easy to get caught up in those predictions and the hype, that surround elections in the stock market. But at the end of the day, remember that your investments should really serve your financial goals, and not your political beliefs.
Yeah, that's such a crucial point.
Yeah.
Investing should be about making those rational, informed decisions,
Mhm.
based on your individual circumstances and your financial aspirations, not about trying to pick, winners and losers based on who you think will win an election.
Exactly. So stay informed, stay engaged, but don't let the political winds, blow you off course. Stay focused on those long-term goals and make decisions that align with your overall financial well-being.
Well said.
Yeah.
And remember, even though we can't predict the future, we can control how we respond to it. By understanding the historical patterns, those potential risks, and the various strategies, at our disposal, we can navigate these uncertainties, of an election year and emerge even stronger on the other side.
That's a great note to end on. Thanks for joining us on this deep dive into the world of elections and the stock market. Remember, knowledge is power, and informed investors are empowered investors. So stay curious, stay engaged, and as always, happy investing.